After raising interest rates to combat high inflation post-COVID, many of the world's big central banks have finally begun cutting rates. Since June, the European Central Bank, the Bank of England, and the Bank of Canada have all cut their rates, but the US Federal Reserve has yet to do so. So when will the Fed start cutting rates? Unfortunately, for a variety of reasons we'll get into, it's becoming more and more likely the rates won't come down at all this year. The Federal Reserve is the central banking system of the United States, and as so plays a crucial role in shaping the country's economic landscape through its monetary policy decisions. One of its primary tools is the manipulation of interest rates, which affects borrowing costs, consumer spending, and overall economic activity. Given the current economic indicators and prevailing conditions, it is highly plausible that the Fed will choose to maintain rather than lower interest rates this year. Several key factors contribute to this stance, including inflationary pressures, economic stability, labor market conditions, and one reason that's unique to this year. Inflationary pressures. One of the main reasons the Federal Reserve is unlikely to lower interest rates this year is persistent inflation. Inflationary pressures have been a significant concern for central bankers in recent years. It was the reason the rates were raised so drastically in the first place. And despite some relief in certain sectors, overall inflation remains high. The Fed's primary mandate includes ensuring price stability, and lowering interest rates could exacerbate inflation by increasing consumer spending and business investment. As of June 2024, inflation rates, although somewhat moderated from peak levels, are still around 3% year over year. Now, this is much better than the 9.1% inflation in 2022, but it's still above the Fed's long-term target of around 2%. In such an environment, reducing interest rates could risk reigniting inflation, making it difficult for the Fed to achieve its price stability goals. Economic stability and growth. Another critical consideration is the current state of the economy. The Federal Reserve aims to foster economic growth while avoiding overheating. Recent economic data indicates a relatively stable growth trajectory, with GDP expanding at a moderate pace. The fears that higher interest rates push the US into a recession have for the most part subsided. Lowering interest rates in this environment has the potential to lead to an overextension of credit, potentially creating asset bubbles or encouraging unsustainable borrowing. The Fed has to be careful to balance its actions to avoid disrupting the economic equilibrium. With the economy demonstrating resilience and steady growth, there is less urgency to implement rate cuts, especially as such measures could introduce new risks. Labor market conditions. The labor market is another important factor influencing the Fed's monetary policy decisions. So far in 2024, the U.S. labor market has shown strength with low unemployment rates and moderate wage growth. The unemployment rate is currently at 4.3%, which is not as low as the 3.5% peak in 2023, but is still well below the post-World War II average of 5.5% to 6%. A strong labor market supports consumer spending and overall economic activity. Lowering interest rates might stimulate additional hiring, but it could also lead to wage inflation, which would further complicate the Fed's inflation management. The current balance in the labor market suggests that the Fed may prefer to maintain interest rates to avoid overheating and ensure that employment growth remains sustainable without fueling excessive inflationary pressures. Global economic uncertainties. Global economic uncertainties also play a role in the Federal Reserve's decision-making process. The interconnectedness of the global economy means that international events can impact domestic economic conditions. Issues such as geopolitical tensions, trade disruptions, and global financial market volatility can have ripple effects on the U.S. economy. In times of uncertainty, maintaining a cautious monetary policy stance helps the Fed to manage external shocks and maintain economic stability. The world today is more unstable than it's been in decades, with major wars in Europe and the Middle East, rocky relations between the U.S. and China, and a shaky world economy. Lowering interest rates amid global uncertainties could potentially expose the economy to additional risks, prompting the Fed to adopt a more conservative approach. Financial market conditions. The condition of financial markets is a crucial consideration. The Fed monitors financial market stability closely, as excessive volatility or disruptions can have broader economic implications. If financial markets are relatively stable, the Fed may feel less pressure to adjust rates. Conversely, a significant decline in market conditions could prompt a reevaluation of monetary policy. Given the current stability in financial markets, there is less immediate need for the Fed to lower interest rates. 2024, the wild card. You may not have heard already, but 2024 is an election year in the United States. Although technically part of the US government, the Federal Reserve is an independent organization that maintains complete autonomy in setting monetary policy. In an era of increasing political polarization, the Fed not only needs to safeguard its independence, but also work to maintain public trust in the institution. Because of this, the Fed must consider the political implication of announcing any new changes in monetary policy. There is currently only one Federal Reserve meeting left before the election on November 5th. The meeting on September 18th is the last chance the Fed has to lower rates, but this is just a month and a half before the election. If the Fed decides to lower rates so close to an election, they risk being seen as giving a boost to the incumbent. Because of this, it is very possible that they will postpone any rate cuts until well after the election. In conclusion, while the Federal Reserve continuously assesses economic indicators and market conditions, the decision to lower interest rates involves a complex interplay of factors. Persistent inflationary pressures, the need to maintain economic stability, strong labor market conditions, global economic uncertainties, financial market stability, and the fact that we're currently in an election year all contribute to the Fed's cautious approach. As a result, it is highly plausible that the Federal Reserve will choose to maintain interest rates this year. Thank you very much for watching. I really appreciate it. If you haven't already, please like and subscribe, and I'll see you next time.